right, so my name is Tom Bonville. I'm joining you from Clear Street, and we're here to talk to you about the derivatives toolkit to today's ETFs. And as derivatives-based ETFs strategies gain traction, issuers are facing more complexity in terms of regulatory and operational needs. Partners are key. Focus on minimizing risks, maximizing efficiencies, and achieving scale. What we're going to talk about today is we have some members from the industry across both banks and brokers, as well as ETF issuers. And we're going to walk through some of the issues that we tackle each and every day. So first and foremost, again, my name is Tom Bonville. I'm joining you from Clear Street. My background is sales and trading across derivative products on the sell side. And right now I'm a member of the Clear Street derivative team. So we are intimately involved in all things derivatives as it pertains to the ETF ecosystem. Next, I want to introduce Rishi Rajan. Rajan, if you could please introduce yourself, and then Raphael, and then Pat Travers. So I'll let you guys introduce yourself real quick.
Thank you, Tom. Quick introduction. So my name is Rishi Rajan, work with West Financial on the product development side. Been background, about 14 years in structuring at banks, derivative products. You may know us as First Trust West products in the market today for buffers and target income and other such. Yes.
Hello, my name is Raphael Zayas. I head up portfolio management trading for Vident Asset Management. We work with ETF issuers to help bring their investment ideas to life, a lot of which include derivative strategies. Happy to talk about that.
Thanks. Pat Travers, the CEO of Clear Street Derivatives, and work with Tom Bonville. As Tom mentioned, everything from trading on the listed side to structuring to total return swap financing for the ETF space.
Great. And so setting the table, so derivatives in an ETF wrapper, there are really three main categories. Option-based, you have OTC products and futures products. We're definitely going to spend more time on the first two. But if you think about option-based strategies within an ETF wrapper, again, you subdivide it into two different categories. The first, option-based, has like a yield component. So someone might be, embedding a short call or a short put or some other type of income generating component using listed or flex options. The other major component is buffer or defined outcome ETFs. Let's get started. Raphael, if you could just kind of walk us through how you bring great things to life at Vident, with particularly speaking to a yield bogey or yield component.
Sure. So when discussing yield, there's a lot of the strategies, or the very clear strategy is, writing call options, although there are a variety of such strategies. And so a big part of how do you think about the yield is thinking about, all right, what's the underlying, how liquid are the calls on those, and how quickly can you execute and how efficiently can you execute given the strategies. And then can you support the operational, side of all that. And so that's what we spend a lot of time thinking about, modeling that out, and then modeling specifically, where do you set your strikes, right? Because that's such a key component of those strategies. And so having expertise for, thinking about where you set the strikes is, well, part of that is product design, right? You either have a yield bogey where you're actively managing the strikes to achieve the yield, or you have kind of a moneyness bogey where you're consistently writing either at the money or a certain percentage out of the money in order to, and then just taking the market yield. And so being thoughtful about those is a big part of product design. And we're, very happy to iterate with, we've built some machinery internally to help issuers think through how do you think about those different options, and then also the tenor, right? How often do you want to roll on now you can roll, 0 day to expiration to weekly, monthly, quarterly, et cetera. And so thinking about those, and then the characteristics of the underlying become important because, there's a lot of S&P call overwriting strategies, but especially for the yield focused products, a lot of them think about, all right, what's a better underlying that has a higher implied vol and potentially better return characteristics and better yield. And so a lot of those considerations go into designing a product. And so I think it's I don't know, it's a fun challenge to think through all those.
And Raphael, how has I guess the inquiries that are coming in? So you start off with large cap basket overwrites to generate yield, and now you get into thematic baskets to generate yield, or you get into single stocks and generate yield. Like, how has that evolved over time?
Yeah, so I think, all of those things, right? So the real key thing is, trying to innovate in what the underlying is. A lot of that has been in the equity space, just because you have the implied vol, and so people are either subsetting the equity space, either like you said, single name or very concentrated sectors, and so that is, I think, how you think it's just continues to develop as far as what are the options, how can you either maximize your implied yield, or how can you think about what's the best net return stream, because I think so many people are focused on yield at potentially the expense of total return, right? And so I think what we're seeing now is people being more thoughtful about, okay, what is the actual total return of it, can you achieve yield and total return in a way that's helpful. And so I think just iterating on those and then figuring out, all right, what's the best underlying for that, and then just making sure that the strategies are implementable in a sane way, because the complexity can compound pretty quickly.
Absolutely. The other main bucket, if you will, for option-based strategies, Rishi is going to talk to us about defined outcome or buffer ETFs. Rishi, if you could just kind of briefly set the stage, what products are we talking about? How have they evolved? How have they come to be such an important footprint in the market?
Definitely. I'd say, like late 2000s, you started seeing use of options more from a hedging perspective, right? In ETFs. And what West did with the first mutual fund, 2016, the first, bring this payoff in the mutual fund wrapper first, and then in 2019 when we came out with the ETFs, the goal was to bring certainty and improve, investor outcomes. So instead of portfolio diversification is the only tool, you add a new tool in your toolkit, which you add this to an existing portfolio, and you suddenly start seeing the portfolio is sharp, and portfolio returns and risk metrics just kind of changing. And the payoff itself is not new, right? I mean, it was traded in the options market for a very long time, but the innovation, I think the key difference, why the timing was right, was to bring it to the wealth market, right? Where investor portfolios, and then in a fund wrapper which makes it accessible to this audience. And our partnership with First Trust, right? It kind of changed the landscape. Right now it's $60 to $70 billion market space, yeah, I mean, the payoff itself, essentially, you're adding some downside protection, and you have to pay for that. So you're selling an upside cap, which basically you're giving up upside in return for that downside protection. And it's diversified now to all sorts of underliers, SPY, the IWM, Qs, international, IFA, EM, and I think it's also hit a relevant critical point where, because of the size of the market and the adoption, investors and financial advisors are asking for what's next in the next.
And Tom, to add to that, I would say from our perspective at our firm in particular, we're a FINRA-based broker dealer, we're a securities-based swap dealer. So we have a cloud-native clearing component, which, quite frankly, is prime brokerage. So it's there's a lot of technical things behind it, but it's essentially prime brokerage. But we have the ability, because it's cloud native, because it's relatively new, we built a pretty robust system that's on AWS cloud services. So we can clear significant volumes in listed options. And from our perspective, I would say, over the past year, the amount of inflow to us on the clearing side for the buffer funds it's been astronomical. First few conversations, without naming names, were funds that, had $2 or $3 billion. Now there's funds with 40 billion going to 80 billion. One of the things I'm sure a lot of folks in the room read, the BlackRock white paper they put out on, buffer ETFs. I think the number was 70 or 80 billion dollars today, with an expectation of $1 trillion in the next 5 years. From our perspective, just from a service provider view, and there's, I think, variety of reasons that, others are less apt to kind of do the clearing business, depending on the sort of structure of the firm, depending on the bank, depending on how it sits on their balance sheet, depending on the punitive damages of the RWAs for those positions. We've been very, very open and interested in partnering with, obviously both the trading side of things and also the clearing side of things, and then obviously with the individual funds. And the amount of flow we've seen is just, it's almost, I wouldn't say too much, but it's been significant. And the growth, just like in the past, I would say 9 months to a year, has been, pretty much a straight line up.
So the next, I think the next major category, we loosely identify as OTC based ETF strategies. Most of what I think we've seen in terms of AUM attraction is swap based, and that's levered long, inverse, thematic baskets, all utilize swaps. Pat, you walk through, what Clear Street's doing for option based strategies. Like, how does that kind of pivot as now a swap dealer? Like, talk to me or talk to the audience about how Clear Street and firms like Clear Street are involved as a swap dealer to support those swap-based strategies.
Yeah, sure. I think most people in the room, obviously in the ETF space, know who the inverse and leverage funds are. The complexes with depending on who it is, multiple strategies to hundreds of strategies and specific names. Thematic baskets, obviously from a construct of a portfolio on the long side and the short side. Ourselves and some of our peers and competitors in the room, provide the same relative service, to the underlying either manager or the provider of the ETF. And we not to make it too simple, but to make it simple, we wrap it up into a swap wrapper, total return swap, and then provide the leverage or the inverse financing back to the client. Now, not as easy as it seems. There's, these are all 40 Act funds. The rules, as everyone is pretty familiar with, they're relatively stringent in terms of, third-party custodian, client assets on the retail side, primarily, very stringent rules that have to be met with a certain, custodial moves back and forth for collateral. It tends to get a little more complicated and detailed on the option side. So there are things like escrow receipts that are involved, and you have to have a structure that's relatively straight through from a processing perspective, with our firm, with the agent with the agent bank, with the client, with the OCC and the regulators and the CCP. So there's a lot of moving parts. It's not as easy as, setting up just a kind of bilateral swap agreement. There's is the documentation and MCAs. So there's a lot of work that goes into putting this together. And as most people in the room know, introducing a third party into the mix is introducing a custodian into the mix, and then obviously having a variety of relatively stringent rules for 40 Act. You have to abide by all of those. So I think once you sort of get the process up and running initially, and I think we were early. That's a lie. We were late 2022 in structuring this up, meaning later in the year, and then 2023 and 4. We were able to build, I think, a relatively good mousetrap in terms of repetitions. And I think one of the things that if you speak to the folks who are launching these funds, speed to market is imperative, and it's really important. I think a benefit we've had on our side, Tom, is with our partners. There's a gentleman, John DeBacco, who runs global derivatives for us. We have a very stringent straight through processing setup from onboarding to third-party custodials to margin requirements to execution, which makes it very efficient. And if you don't sort of build those processes, you will not have an efficient business, and you won't be able to handle the volume because, as you know, everyone in the room knows, you're not sure what the next, sort of hot market is, what the next hot ETF is, what's the next sector, what's the next theme. If everyone knows, let me know, please. But I think we're all, uncertain. So there's, a lot of trial and error. So that's a significant part of it. And we've had the ability to satiate that, which has obviously allowed our partners to grow pretty significantly over the past few years.
Yeah, I mean, I would just echo that. Yeah, speed is quite critical when you're trading particular leverage products. And I think one of the interesting things we're seeing is that there's a lot of issuers looking to be smarter about using leverage. So I think there's we've seen a lot of growth in the inverse and 2x and whatever leverage products. But I think also deploying leverage as an investment tool, I think we're in the early innings of that in the ETF wrapper, and I think I'm excited to see how that plays out. But all the work and all the infrastructure that's been built to support all these leveraged inverse products can really be used, in the marketplace to achieve, investment results, for maybe, to bump up the, achieve the efficient frontier of your investment universe, right? And so a lot of you think about like what the people think about the efficient frontier of investments. Leverage is often part of that calculus, and the fact that this infrastructure is there, I think, is going to be really exciting to see how that gets deployed in the coming years.
Excellent. Another part of the OTC segment is some of the quote unquote new kids on the block that are coming into an ETF wrapper. Rishi, you want to just outline some of the new products that we're seeing that kind of can be categorized as OTC in nature, or I guess their beginnings were in OTC, traditional sell side finance products?
Absolutely. I would say as the options-based and defined, target outcome world or target income side of the world has matured, the interest and ask from the investment community, and especially the advice side, as opposed to, I would say most of the levered products sit on the self-directed brokerage side. On the advice side, we are seeing a lot of interest in payoffs that require over-the-counter hedging. And as an example, there've been a slew of filings around auto-callable payoffs. It's kind of like a enhanced barrier income version, but it's a huge part of the structured note universe today. Like the structured notes market is about like 80 billion. Half of that is in auto-call, and so there's a huge like advisory base that's already using it. But in a fund wrapper, just like with the buffers, it opens this whole market segment to a different allocation and different pocket of investments. But yeah, so there are other examples as well on the derivative side. There are some interest rate hedging, or ETFs that are used for interest rate hedging, which use interest rate swaptions in them, which is such a off the bat, not many people understand how a swaption would work. But as a tool, when you package it in a fund, it's not a huge part of the market. I'd say about 100, 200 million, but it's a interesting tactical tool on fixed income.
And then Rishi, you were talking before about how you think some of these new strategies aren't actually cannibalizing the advisor community, right? Can you talk about that? I thought that was really interesting.
Sure, yeah. So one of the interesting concepts, like we work with a lot of banks as part of our counterparts, both on listed options execution side or now on the OTC side. And like when buffers started, as an example, it was predicted that they would cannibalize the structured notes market. And to a certain part, like there were users who've switched. But what like a big part of this is like when you put in a fund wrapper, there are places that notes with credit risk cannot go to. Like as an example, notes are primarily placed in brokerage side of the investment. It's not on the advice side. So like I'd say today the market for buffers being on 70 billion, it's bigger than what the called speeders back in the day for the same payoff. what used to exist on the note side. So we see a similar profile even on the even say for auto callables, like an expected path for it. Similar that there's the amount of education and the amount of the usage of the fund wrapper and where it sits just changes how investors can use it.
But 1 + 1 actually is 2. It is getting bigger. That's great. The other part of it is, are there any concerns as you move from a, bank dealer market, which is OTC in nature, and now you have a, ETF wrapper, which then goes to the street for execution? Like, are there any discussions in terms of comparing execution costs from going the ETF wrapper versus the the bank's broker route? Is that comparison being sold via RIA channels or any other channels, or is that just a topic to debate and something that we'll let time figure out?
So if I may start, scale, like in derivative products, how you trade experience, in your portfolio management team, your traders, and your relationship with your market makers, whether they're banks or independents, it makes a huge difference. I would say it's not very different than when you talk about fixed income as well, right? Like as that space just exploded, ETF side, there are liquidity. When you have size and scale and the relationships, it definitely, sitting on this side of the line, it definitely makes a big difference. But I think there's also an element of like market structure evolution that's happening. Like flex options as an example, it was a much smaller side of the market, used to be traded primarily in the interbroker between banks. Today, especially on the 1 year and sub 1 year tenor, it's the funds that are the largest part. There are some RILAs and insurance products well in that space, but the amount of infrastructure that's been developed in the market, like between the exchanges, between DTC, OCC, doing in-kind transaction. Now there's a big project that's presuming next 6 months to a year, fingers crossed, goes live, but it allows for straight through processing of an in-kind order, starting with an ETF and then settling in OCC settled options. But to your point, like when both individually as an issuer with scale, that difference comes in, and then as the industry, that segment itself grows, there are a lot of, you don't see this sitting on the outside, but there are a lot of automation and a lot of, like regulatory pieces have been put together.
Yeah, that goes into our side as well for any service provider, bank or a broker. There's our biggest risk, well, market risk obviously, but outside of market risk, operational risk, clearing risk, like that's a big risk, right? It's something that you generally see price compression from sort of executing brokers, but when you start getting into, as we mentioned earlier, we have multiple counterparties involved in this. You have a lot of money transfers, back and forth. It does take time and energy and effort from an execution perspective, but then the real risk is, the most important thing for our clients is obviously soundness and safety of client assets, efficiency with transfers and withdrawals and things of that nature. But there's a big operational aspect of it that you can't, price compression has occurred to some degree. I think when you start getting into putting flex options up and putting OTC options up, and numbers all of a sudden get into the tens of billions of dollars of notional value, the price compression kind of it's not a premium, but it kind of gets to fair value, if you will. Because that's one thing that we're worried about, and that's having operational efficiency, both from a regulatory perspective, from a fiduciary perspective, but also from a firm perspective. It's a pretty serious matter, and there are a lot of moving parts in this.
Yeah, we're I think as a firm, Viden is definitely investing a lot in technology and operations to support this business, because like you said, like it's just so very critical to the outcomes, to achieving the outcomes. the other thing is, I'm a legacy equity guy. And so I think having what's interesting, like Rishi mentioned, is that the scale really does provide a benefit. So, on the equity space, when you get big, you start worrying about like what's your impact in the market. But when you're talking about these large contracts and systematic trading of them, it ends up that your size ends up becoming a benefit because it attracts other market participants and makes the market more efficient. And so I think that's just been a fascinating kind of thing to witness in the ecosystem, is how the market kind of has been able to grow rapidly, and it's worked out really well. And so I don't know that everyone thought that was going to be the case, but I think there's a lot of evidence to suggest that there is sufficient liquidity for these kinds of products to grow because a few things, but I think having using consistent underliers helps a lot. So that's an important consideration, right? And then the systematic approach to trading really helps make it clear for market makers, what they should expect and how they can, provide liquidity.
Great. The last major category of derivative-based strategies that are making their way into ETF wrapper are futures-based. So obviously, with the ascension of crypto, all things crypto, that is a big part of the market. I know when we were talking before this panel, we discussed the idea of using Cayman entities or not using Cayman entities. Raphael, I don't know if you want to start the conversation, but why is it that futures-based strategies have a Cayman entity? What's the driving factor? And then we'll take it.
Yeah. So one of the big product decisions you have to make as you're thinking about launching a new product is if you're comfortable with your investors getting K1s, right? And so and that is pretty much universally hated. So the purpose of the Cayman entity is to shield quote unquote bad income from the investors and make it so that the distribution, you can be K1 free. Sometimes the fact that a commodities ETF won't issue a K1 is so important. It's actually in the fund name itself, right? So so that's a very important product decision. And so I think that the discussion of the Cayman has become more popular. Not just because we're seeing growth in commodity strategies, and certainly with the global macro uncertainty, I think people are evaluating commodity strategies on their own. Maybe that's another topic, but but especially the growth of crypto as of cryptocurrency futures, and then the cryptocurrency ETFs, the spot ETFs, has created a lot of interesting ways to gather exposure to cryptocurrency. But not only that, now it's opened the door for a lot of the derivatives-based strategies that we've been talking about on cryptocurrency underliers. So you can have leverage through futures. You can have a call overriding strategy with a crypto underlying, and hey, the volatility of that is such that that's actually potentially, that's a compelling product potentially for investors who are looking for those really, high vol underlying strategies. And so what we've been seeing is working with clients is, there's the crypto, we work with a variety of crypto issuers who have, we kind of are, you could think of Vidant as playing a role in the traditional finance space for a lot of crypto firms. And so, we kind of sit in the middle and could kind of look at them play nice on the TradFi side, if you will. And so what we're seeing is now that we have the spot ETFs, now we can build the leverage and the other, overriding and all the strategies employing derivatives on the ETFs. That's a boon. But then depending on that, you might have to think about the Cayman. So there's a lot of the product design is going into thinking through those issues and then making sure that we can deliver the experience that, the issuers that we're working with want to have for their clients, their investors.
Great. So, I mean, in all these instances, you have, fund manager, ETF issuer, might have a sub-advisor involved. You have a swap dealer and/or prime broker. In your vast experiences, what has been the most meddlesome part of that equation? You have a lot of players, you have a lot of things that have to go right in order to get the scale, efficiency, and the cost down. What do you spend most time on that is not just core, investment decisions of the ETF or actual execution of the ETF? And Rishi, maybe we could start with you.
Sure. And I can sort of put aside my product dev hat more as a firm dealing with derivative products. I would say the most time consuming aspect is the lack of automation in all parts, like especially it's changed, as I was saying, like last 6-7 years as the size of this segment of the industry has grown. There's been a lot of changes done, but how do you track orders? How do you fill when you're doing basket orders versus single options? Like, that's a big change. Most people used to, like most firms, were just trading single options till funds started doing packaged options. And then some very interesting things about, like, everybody's trading penny strike calls now, or near zero strike. So there's strike overlap. There's some interesting, congestion topics that come up. But yeah, I mean, it's dealing operational issues because there are no centralized, booking systems, especially in the flex world. The more OTC, the more bespoke you go to, the harder. I would say that would be that.
Yeah, I think all the operations around trading can be really scary because, especially like you said, if you're talking about multi-leg options, I mean, they have to be traded as a package. Otherwise, you run significant investment risk, right? And so building up that infrastructure to compute the trades as a package and then get them traded as a package and making sure everything there's a lot of diligence and just so much diligence and I say trading expertise that's required to make sure that the investment process behaves smoothly. I think is and I think it's hard to overstate just how much that is part of our firms. The day to day at our firms is just how much we have to keep our eye on that. And so there's that stuff. There is the other thing to consider is obviously the cost of capital, right? You have to just think about what the financing costs are, or just thinking about how do you manage cash? Where's cash? Is it earning the best yield for the best outcome for your investors? And managing that, I think, is critically important. And then the other thing is there's just so many different gotchas depending on the thing. So it's like, how do you do tax management for swaps is one issue. We could talk, how do you think about tax for swap-based strategies? And then how do you think about setting up the infrastructure for flex options where they don't exist when you're trading them at the time you're trading them, right? That's so dealing with a lot of theoretical prices is something that I think is a lot of firms, before we got into that, our firm wasn't used to, and we had to build that out. And so I think just thinking through all those issues is quite critically important. And then not only that, you have to do that within infrastructure that provides sufficiently robust trading checks and pre-trade compliance and all those other things that are required, that are like the table stakes for managing money at an institutional level. And so just thinking through that collection of challenges has been what we spend our time worrying about. And I think it's been it's been quite a bit.
Yeah.
Sorry, we see the same thing on our side, and it's imperative, and kind of having some folks on the team that we built out over the past 2.5 years or so. We've fortunately had the experience to know what this looks like, understanding how quickly it can move, understanding the sort of volume that flows through. So we've depending on the week, we have anywhere from 40 to 120 new product launches within our firm, which and listen, so more unfortunately don't succeed than do to the numbers that people are familiar with. but it's repetitions and making sure that, straight through processing efficiency has to work. You have RIC protocols you have to follow. You have a lot of, we do not give tax advice, but we obviously deal with, external counsel and clients counsel on, making sure there's tax efficiencies and things are, sort of done the right way on, triggers and resets. And there are a lot of moving parts, but creating the efficiencies, creating the systems to be able to, manage it straight through is just imperative. Like you can, I think, be successful, have a small number of relationships clients, but if you're going to, build out, a product, kind of globally for all sectors and verticals, asset classes, it has to be straight through. And we see the same thing. I think our clients and advisors see the same thing as well.
One interesting point on that is like market structure changes, like a lot of firms also, right? You see a restriction, like the market can only do this much, and then you just blend your process around it. There's another part which, I mean, even Clear Street I've seen as a fintech based, now pushing the boundaries of what prime and clearing can do. We as a firm firmly believe that like if you see something that's missing in the market in terms of how it should be done to make things more efficient, we've worked very closely with our exchange partners, with even with the regulators through our council or in other channels, and clearing houses as well, right, to request and then take a long-term view on it, right? Those changes, market structure changes, don't happen like quickly, but
Right.
If it's 3 years, 5 years, but you have to keep pushing the line so that it evolves to make things.
Yeah, and you take the example of a flex option. A decade ago, it might take you hours to list and then hear a quote, an opening quote in flex options, and then get permission to finally trade it. And now they're, traded on the fly in seconds. Quite amazing. The age-old question for me, I think for the audience really is like, well, what inning are we in? I mean, the last 2 years has certainly been exciting for Clear Street. We're kind of, not to plug our own book, but we're right in the middle of all these things, which are constantly changing and evolving, and it's really exciting. But in your best guess, if we could go down the line, like Rishi, for buffers, like what inning are we in? Like, is this inning 7 or 8, or are we in like 1, 2?
Me personally, second inning.
Attaboy.
I would say more qualitatively is like you've reached an inflection point where it's like the ETF industry. Like there was a time when every conference we go to is like, what's an ETF? Like here's how a no arbitrage condition works. And like now it's about what's the next big innovation. Everybody knows what ETF is. I think that change is happening now where the usage of buffers and portfolios or options-based products is now hit a certain understanding level in the market. So it's now getting to what next or how else can we use and percolate it across. So that's sort of, I see this as second inning and then a lot more innovation.
That's great. Many more years to come. Raphael, what about the yield-based products that, as far as you could see, is this a saturated market, or are we still in early stages?
I mean, from my perspective, it seems to be early stages, still first or second inning. I think there's still a lot of innovation as far as what the kind of product, like I mentioned before, there's the yield, but there's also the total return component, and then the tax management side of it. I think there's still some innovation to be had and some products to come out. The other thing is that I think it might be the case that we're seeing a market environment that is more compelling for some of these either defined outcome or call overriding strategies, right? If you're anticipating choppy markets, right? If you're anticipating certain market environments, it might be the case that some of the non-standard kind of equity strategies might be better, and we're coming off of the best, equity run in history, right? If you think about that, right? From the global financial crisis to, recent times, they have COVID, but for the most part, we've seen very, very strong equity markets consistently. And so if you think about, okay, if that even slows down a little bit, how will that impact, asset allocation decisions? And I think a lot of the strategies that we've been discussing become more appealing as, and especially if you think about the correlation between bonds and equities, also maybe approaching closer to one, some of these strategies can make a lot more sense in asset allocation decisions. And I think, but these income strategies are still, so new. I don't know if that's fully baked in. And I think, like Rishi said, I'm sure he would say that the buffers aren't fully integrated into that asset allocation thinking yet. And so I think it's going to be, it's very interesting. And I think there's a lot of room to go still.
Yeah, we attended the what was it called? Bitcoin 25 crypto conference in Las Vegas last week, which was interesting to say the least. But nonetheless, we met with a fair number of corporates. There's a few that actually have some ETFs listed on their securities who are in a crypto treasury function. And it was interesting when we would have conversations about our firm with our banking folks for underwriting, raising capital or debt, depending, debt or equity, depending on, the structure. And they wanted to employ, for whatever business they were in, a kind of crypto strategy, similar to what others have. And the sort of response that we got from a bunch of folks were like, well, do you guys know the levered ETF space as well? So their thought process is, I think there's a sort of cadre of investors, right, and globally, by the way, which are not insignificant, that can't get access to crypto in their current country, view this and look at this market segment, and it's a pretty significant amount of pent up demand. So I thought that was pretty interesting, in that I didn't think that was going to be the topic of conversation around levered ETFs for folks that are in crypto, that have core strategies, really crypto treasury. But we got asked the question 7 or 8 times, which I found to be pretty interesting. Which I didn't think that would go down that road, but they're all sort of looking at it and realizing that there's again, supply and demand, and the demand globally from retail is not insignificant. So I think I'm gonna say maybe bottom of the second.
I think that brings up an interesting point, though, because I think there's a lot of derivatives strategies that employ derivatives that are more retail focused. So you think leverage, inverse, potentially, and then more trading vehicles, and then you have strategies that are more institutional. And I think so I think what's going to be interesting is how that continues to play out. So I think it's certainly right now it's been products are designed for one audience or the other almost. It's what it feels like to me. But I think we're going to start seeing the blend between those. And then certainly it's the case that some of these retail product, maybe not leverage, we'll see about that, but a lot of other strategies, I think some of the income strategies are potentially first taken up by retail audiences, are starting to get approved on different platforms. And so I think thinking about how these strategies kind of sell to both sides is going to be interesting. And I think there's a lot of crossover potential still to be untapped.
It's great. Well, it's not common that you have 3 people talking about derivatives and they're all bullish. Usually there's a Debbie Downer somewhere in there. We have about 7 minutes left to the panel, so I think we'll open it up to questions at this point.
Thank you. Thank you, everyone. That was very informative. Kind of a 2-part question here. There's a lot of talk about 6C11 and share classes breaking down barriers and allowing tons of ETF to come to market. But I think kind of the unsung hero in the deluge of launches can be 18F4 for all the reasons that you've outlined here today. So, can you lever? Can you put income? Can you buffer anything that has a derivatives market, or is there an underlying where maybe you say no thanks? Not that everything should be, but that kind of leads to the second question. We heard other panelists say there's a capacity issue. So how does us being in the second inning of this market feed into the capacity issues that have been already discussed?
Sure, I can start. I'll address a couple of points. There are a few questions in there. I would say capacity for one, right? The capacity grows as new money comes in. So there's definitely been, like, options trading over the last, sort of post-COVID, or take the COVID point, right, which is also marked where the option space ETF AUM outside of covered calls, has basically just exploded, actually including covered calls as well. So I would say this part goes hand in hand, and the question really is, can you grow in a smooth fashion as opposed to turbulent, with lots of fits and spurts and breaks, right? So far, there's been good precedence that the market participants, liquidity providers, they're all, and exchanges, right? They're all kind of motivated to keep this steady, stable while the capacity grows. So that's one. 18F4 definitely is something, especially when leverage comes in, like now that the payoffs are getting, both on the option side, not even talking about just the swap side of things, but, and that is, I'd say, in a way, at least on the advice side, it's not a bad restriction to have, but, solving it and working within it, there's still a lot of room to go.
Yeah, I'd say that it's certainly the case that certain strategies are still challenging for a derivative, like not very liquid, creating strategy of, say, options where the underlying is not very liquid, actively managed single stock portfolios is still, I think there's still some challenges there. Now there's some great investment returns there, and it could be managed, but I'm curious to see how that plays out. And so I would say that I think is going to be a little bit slower than a lot of other things. Like, similar strategies, like you mentioned, on different asset classes, there's still room there, and tweaking those strategies. But, I think as you think about all these active managers that might be coming to market, and then what can they do with derivatives on top of their portfolios, I think the daily liquidity requirements of the ETF wrapper are potentially still a challenge for some part of it. So I think now, having said that, I'm still very bullish on this, of course. So I think one of the key considerations is really being thoughtful about how you design a product, and then making sure the ETF wrapper is a good fit for it, right? The ETF wrapper is not a perfect fit for every strategy that can be devised. And so just acknowledging that, I think we're still working with a lot of people pushing the envelope to see where is that boundary, right? And so I think we're starting to see the outline of where some things might start to approach difficult. And so, yeah, it'll be interesting to see how that plays out. And I think what's interesting about the ETF wrapper is that this is all very transparent, right? So I think people are going to, it'll become obvious. People will talk about it. There'll be analytics on this. And so people will understand, okay, you can do this, but not that, or that didn't work out well for that fund because of this. And so it'll be interesting. And then we'll see. But of course, if a product gets hot, or product category gets hot, Rishi said, capacity begets capacity.
And from our perspective, we're obviously the liquidity provider for a lot of these products. So we're super cognizant when we do a review from a risk perspective on a VaR-based model, on what the security looks like, in terms of peak to trough volatility, obviously, is a component. Market value of the company is a component. So we're very cognizant of the risks for the underlying security. And by the way, there's also a 40 Act component of the underlying investor where, not that we're a fiduciary to the underlying investor that the fund is, but there's just names where we can't get comfortable with it, and we'll watch it maybe over a certain period of time. But we try to limit depending on the funds with underlying securities with 250 vol that have $4 billion market caps. Like, it's kind of a hard that's a hard one to get past. So we tend to be. But we have great dialogue with our partners, but we also, we tend to make sure that we're looking at the risks the right way across the board, both from our perspective, from a risk management perspective, but also from the fund perspective.
Great. Anyone else? All right. Thank you very much for your time. Thank you very much, panelists.